Hughes, Chief Market Analyst here at Scope Markets. Let's look at how these markets are performing. And of course, the start of the week has seen unrivaled volatility in stock markets and the US dollar. And on Monday, we saw US stocks have their worst down day since the crash of 1987, as the Dow fell almost 3,000 points, while the S&P fell over 12%. This is as coronavirus, of course, continues to wreak havoc, not just on financial markets, but on the global economy. The US dollar has in fact fallen over the last couple of days on the measures brought in by the Fed at the weekend. Historically, stimulus packages and rate cuts are positive for stock markets, but have a negative effect on the currency. It's hard to get a gauge on what could be coming over the next few days for the US dollar, but the economic calendar does not stop for the crisis. Wednesday will see building and housing data for February, and it's likely to be the last month's worth of data that shows minimal impact from the virus. Yesterday's retail sales data is already showing a downfall from the coronavirus, as that number fell to negative 0.4 from an expected plus 0.6. Europe will today focus on closures of borders in many European countries as France became the third country to completely lock down. Markets have been focusing on the fact that Europe is the epicenter of the coronavirus, and ever since the start of the week, the euro has been under pressure. The issue in Europe is that the central bank does not have the tools at its disposal to help the economy like other nations and central banks have. This is due to the fact that the economy in Europe is yet to recover from the 2008 and the 2011 debt crisis. It also means that interest rates have yet to recover, and the stimulus is still being pumped into the economy, which remains broken. The euro has plummeted over the last couple of days, yet again against the likes of the US dollar and even the pound, as it has seen increased selling pressure. The euro is seen as a more risky asset at times like this, due to the fact that the Eurozone economy is one of the weakest to be affected so badly by the coronavirus outbreak. The UK government has been acting to try to protect the UK economy with yet another huge stimulus package announced by the Chancellor of the Exchequer on Tuesday. However, the government is being urged to do more for families and workers affected by the coronavirus crisis, despite announcing a £350 billion package. The Chancellor, Rishi Sunak, unveiled an unprecedented set of financial measures to support the UK through the coronavirus pandemic. They include mortgage holidays for those in financial difficulty, as well as £330 billion in loans and £20 billion in other aid to protect businesses facing losses as a result of the virus. The pound remains under severe pressure despite the measures taken by the government. However, as we know, this is a fast-changing story, with stimulus and advice for businesses and individuals changing on what seems like a daily basis. The pound has been one of the currencies which has really suffered over the last couple of weeks, some of this brought on by perceived lack of action taken by the government. However, now even though the government seems to be acting on a daily basis, the downside for sterling is set to continue. Markets again today are set to open in negative territory. They've opened in negative territory in Europe, and US markets are set to wipe out all of their gains made on Tuesday. This story will continue to dominate markets and is likely to plunge us into a global recession for a long period ahead.